Hello again. It's a pleasure to have Jane Mendillo here. I gather a rare pleasure, so we're delighted to have you. I think Jane has probably one of the more challenging and interesting jobs. I'm not sure I'd say enviable, but challenging and interesting, running over a $30 billion endowment and doing it at a university. Jane, let me just start with a very basic question. This is a conference on alternative investments. What's your philosophy towards alternative investments, and what percentage of your portfolio do you devote in that direction?
Alternative investments play a very important part in our portfolio. Over 50% of the portfolio is in what we might call alternatives, a combination of hedge funds, private equity, real estate, and natural resources. And that proportion has grown significantly over the last decade or decade and a half. Back in '95, I think we were about 80% in public markets, and then a small proportion in each of those areas I just described, private equity and real estate in particular. And since that time, we've gradually built and taken advantage of some of the opportunities in alternatives and really driven the performance of the portfolio.
So what areas of alternatives are particularly growing now? I mean, what are you seeing that you're particularly interested in?
Well, first of all, to start with probably the first one and the largest is private equity. Private equity has been a driver of our returns over the last 10 and 20 years, probably the highest performing asset class. We've talked about this a little bit already today. I saw the David Rubenstein interview this morning, and it is, private equity is a more crowded trade today than it was 10 or 20 years ago. We're still building that part of the portfolio. We like private equity, but we're very particular in what we're doing there going forward. And some of the other alternative asset classes are growing at a more significant rate in the portfolio today. So, for instance, natural resources is an area that 10 years ago was probably just a couple of percent in the portfolio, and today is over 10%, and hopefully growing from there.
And you have an interest in timberland and farmland, which seems a little unusual. Where does that come from, and why do you think that's a good investment?
Right. So natural resources, as I said, is a growing area we're very excited about. The thesis is really a simple one. We want to buy things for Harvard that will be in greater demand in the future than they are today. And when you think about something like timberland and emerging markets and the growing middle class and the growing infrastructure that's needed throughout the world, and the amount of land that it's dedicated to growing trees and wood, there's a very interesting supply-demand mismatch that we've already begun to see play out. But we entered this area probably 10 or 15 years ago when it was really an undiscovered asset class, and just began to feel that if we could buy things today that would be in greater demand in the future, there would certainly be a repricing of the asset going forward, and Harvard would benefit from that.
Just back to private equity for a moment. I think in 2011 you had said, perhaps maybe it was your letter that you do, that it looked a little crowded. It looked as if returns weren't going to be so great there, and you were pulling it back in the portfolio. And then I think last year you said, well, you're seeing some interesting opportunities and we're ratcheting it back up. Did something change during that period, or was it a change in your philosophy, or what accounts for that?
There has been some evolution in the private equity business, and again, hearkening back to one of David's comments this morning, there was a golden age of private equity, 2002 to 2007. It was great returns, easy to raise a fund, a lot of allocation coming from institutional investors and including endowments like Harvard. And then things got very crowded and very quickly. And there are a number of relatively new entrants into private equity investing, including sovereign wealth funds and pension funds, that have swamped the field with uncalled capital commitments, growing asset allocation within their portfolios. So yes, we did pull back our enthusiasm for private equity for a bit. I think some of that over-allocation, uncalled capital, dry powder, so to speak, has peaked out. And we're also very committed to staying with the asset class. Again, the dispersion of returns is very wide, so with the highest possible conviction managers, and being opportunistic about how much we allocate going forward.
Okay, just one other, I want to get to hedge funds in a minute, but real estate, that's an area you're interested in, but generally that's not through funds. How do you think about real estate, and why are you interested in it?
our strategy in real estate has changed over the last 3 or 4 years. We had done real estate investing primarily through funds up until about 2008, 2009. Our experience with real estate was okay, but not as good as I would have hoped. And also in the crisis, it seemed that there was a real opportunity to think about real estate in a different way. So of course, as we all know, real estate values came down dramatically. Real estate managers found it very difficult to raise funds in the couple of years following the crisis. And our real estate team, which had been revamped and repopulated during that time period, felt that the most rewarding strategy would be to go ahead and make our own investments, and either on our own or through joint ventures. But rather than dedicating more capital to blind pools, pick niches of the real estate market that we think are particularly fruitful, and make our investments there, and have more control over our entry and exit into particular properties, niches, geographies.
Which niches are you especially interested in?
So we get that question a lot, and my real estate team gets really angry with me if I answer it. So I won't answer that, unfortunately. But you know, we're looking for things that might be under the radar screen of some of the large real estate funds that are out there. So in terms of size of transactions, something that would be more in the small to moderate size, as opposed to something that a very large fund might go after, or some of the smaller end of the market that's dominated by wealthy family and individual. So try to hit the sweet spot in between.
Can you say if it's more domestic, U.S. or elsewhere? Will your people not get too mad at you if you say that?
We have been, over the last few years, much more focused on the U.S.
Yeah.
than on international in real estate. Again, I think investing opportunistically in a very good time in real estate, and starting to benefit from that. And we'll see as things develop in the U.S. Whether we think that it would be more opportunistic now to go overseas.
Let me just turn to hedge funds for a moment. At least on the face of it, you have a lower exposure to hedge funds than some of the other IVs. I think it was like 15 or 16%. Why is that? And can you talk about how you're viewing hedge funds right now?
Sure. Well, we have a pretty unique structure at Harvard Management. It's about 200 people who are working on managing the Harvard Endowment, and we use a mix of internal managers and external investment management firms. In fact, some of our external investment managers are here today, so thank you. What we do in our internal team is largely in public markets, and much of it is what you might find in outside hedge funds. So an arbitrage strategy, a derivative-based strategy, something that might not hit right down the traditional middle of how stocks and bonds are managed, but that's been one of the strengths of Harvard Management for many years, and actually decades, is trying to find those market inefficiencies and exploit them for better returns in the portfolio. So we see a lot of what we do in our internal team as hedge fund activity.
Yeah.
And it would overlap and perhaps collide with outside hedge funds in some ways. So what we do in hedge funds externally is really to complement what we do internally.
Yeah. Just during lunch, just before this session, I asked at the table what people wanted to know, and I got a couple of talk about Harvard versus Yale in terms of philosophy. Can you give us a little sense of that in terms of investment philosophy?
Sure. I think that the two institutions are pretty similar in terms of broad investment philosophy. Diversification is a key to both of our portfolios. Good exposure to equity or equity-like investments that are going to have growth potential, and we're both feeding very important institutions for a large portion of their budget, and we know that in order for them to do what they do, we need to produce returns and grow over time. But then you get to the actual implementation, and the implementation is different. We have had, from the beginning, the philosophy that doing internal investment management would be to Harvard's benefit for a number of reasons. It's actually a cost-effective way to manage money, assuming that we get the investment talent and the returns that we need to get. We have more control over our assets. We have more transparency. We have more flexibility, the more that we do internal management versus external. Yale has had many decades of experience with using all external management. They've obviously been successful with that too, so there are different ways to go. But I think that given our size, and we are the largest endowment, and a good, we're about $30 billion, I think Yale's about $20 billion. So a good $10 billion more in assets to put to work, we have the benefit of being able to do some of that through internal staff that we've hired on our own. And I can see that we will be able to outperform through those strategies, perhaps a little bit more reliably than external management.
Yeah, I mean, of course, Harvard has had historically challenges with how it manages internal versus external. I think there was a bit of a, almost what by Harvard standards I'd call a scandal over how much internal managers were getting paid, and there was a shift away from that. And probably you ended up spending more on external managers than internal, but for political reasons it seemed necessary. But now you seem to have been able to shift the balance back. So what happened that has enabled the community to accept the fact that you have high-paid internal managers?
Well, one of the interesting things about working at Harvard is that nobody cares at all what you do. It's never covered in the press. It's never it's never talked about on campus. It's quite the opposite, actually. We get a lot of attention for every move we make in the portfolio, every hiring move we make, and our compensation, for sure. And so it's been a controversy from time to time whether Harvard Management Company, a professional investment management firm that manages money just for Harvard, should be able to pay its professionals in line with the investment management industry, or rather in line with the campus community. The fact is that managing money through internal management and through the hybrid model that Harvard Management uses is, as I mentioned earlier, very cost effective. We do hire the best and the brightest in the investment management world. We do pay them for outperforming their market benchmarks. Everyone at Harvard has a market benchmark, and they earn incentive compensation when they beat that benchmark. But they get paid a portion of it in year one. The rest is held back for 2 years, and if there's underperformance in the following years, that's clawed back. It's a very straightforward system. It means that people can make a lot of money when they really outperform their markets and when they've really added value to Harvard. I know from my own experience in working and managing the Wellesley portfolio and working on the Yale portfolio when I was on the investment committee there for several years, it's much, much more expensive to manage your money using all external managers. We've had spin-offs of Harvard Management that have left our company and become outside investment managers, some of whom we still employ and are fantastic contributors to our portfolio. But we certainly pay them more now than we did when they worked for Harvard Management. So.
Yeah. Are there other things different about managing money for a university, for example? How much liquidity you need, because I think you've said that about a third of the operating budget for Harvard is supported by the endowment, and certainly during the downturn, I think liquidity was an issue. What about volatility, how public it is? I mean, do you work in somewhat different constraints from somebody who's just managing more generally?
I think we do have different constraints. We also have different motivation, which I think is a positive. So there are pluses. We all come to work every day feeling very good about what we do. And many of the individuals who manage money for Harvard, at Harvard Management, have come from Wall Street, come from the South Side. And the fact that we come into the office and we're making money for Harvard, one of the greatest institutions of higher education in the world, and one of the things that the United States probably still does better than anything else in the world, and anyone else in the world, it's a great motivator. So we have the plus of working for the university. The minus of working in a university environment versus other environment might come down to the fact that there is a great reliance on this pool of capital. And so volatility has to be understood, liquidity has to be understood and managed in a way that may exceed what people need to do with other types of accounts. On the other hand, we do suffer volatility, we do have a very long-term horizon, and if we manage things well and keep our risks under control and our overlapping risks with the university under control, we can take a very long-term view and ride through the volatility.
Great. By the way, I should have mentioned that Jane has also agreed to do Q&A at the end, so if you want to think up some questions, you'll have that opportunity. We had some disagreement this morning, clearly on the podium, about the U.S. and Europe in particular. Were these places that were good places to invest, particularly into distressed industries and distressed properties, or were these basically disaster areas that you wanted to avoid? What's your view on those?
I think it's interesting how quickly views have cycled through this. So even when I started back at Harvard Management in 2008, 2009, of course, we were having our own crisis in the U.S. But I remember asking investment managers who came in about the euro. What do you think was going to happen to the euro? Is the euro going to break up or survive? And in that first couple of years, the idea that the euro could break up was laughable. So people would answer that question by saying, of course not. There's no chance the euro is going to break up. A year later, we're asking the same question, and they're saying, well, you know, many of the people who visit us are saying we're not sure, and maybe it should break up, and maybe it won't survive, and how can it survive? And now we're kind of coming back through that cycle again, and the euro sounds like it's going to be okay over the long term at least. And will the participants change perhaps, and will there be angst between now and smooth waters? Yes, that I think we're seeing that right now. But we think that the Eurozone and IFA in general is still a fruitful place to invest, and actually may have some really interesting opportunities coming out of this time. And in terms of emerging markets, we have been pretty heavy investors in emerging markets for many years now, and we continue to be. Emerging markets are the place where growth is continuing to happen in the world, and as David said this morning, you know, whether it's 10% in China or 8% in China, there's a big difference between 8% in China and 2% in the US or 0 in Europe. The market and the economy doesn't need to be growing for us to find good investment ideas. And I think we are finding very good investment ideas in, for instance, in private equity in Europe today. And growth is 0. But where there is stronger long-term growth, as in emerging markets, as in Asia and South America, there really is, I think, opportunity for investors who are aware of the way to find those opportunities, the risks, and the good managers in those geographies.
How do you decide which emerging markets you're going to be interested in? Because it can't be just what the investment opportunity is. It also has to have something to do with how risky it seems, what the geopolitical situation looks like. There's so much instability in the world. I mean, do you steer away from, you know, Middle Eastern countries? Do you steer away from places where you think there's going to be instability? Or are there opportunities there?
Yeah, there may be a difference between where we will go with private investing versus public investing. So, for instance, in some emerging markets, we would rather be in public markets than in private equity or real estate. Part of that has to do with the experience base of the investment management that we can find there. Part of that has to do with the rule of law and whether it exists to the extent we need it to, and how well we can understand it, and how much we think it might change once we're there.
Right.
So being able to be nimble in those markets is important in many cases, and really understanding what we're getting into. So there have been times when we've gone to a really more, a newer, more frontier-like market with a small amount of capital, just to try it out and see how it goes. And in some cases we try it out and we retreat, and in other cases we try it out and we say this is going to work for us and we'll do more.
Okay. I mean, recognizing that you have opportunities regardless of the macroeconomic environment, I think everybody would be interested in getting your assessment of how things look both in the U.S. and globally going forward. And is this stuff happening in Washington very problematic as far as you're concerned, in terms of whether, you know, we have frankly a functional government that can make budgetary decisions, or do you not think it's that relevant to the way you look at the world?
I think having a functional government helps everything. I think that, you know, well, as investors, first of all, you know, a 2% risk-free, under 2% risk-free rate on the U.S. Treasury makes everything challenging. We take that as our base rate and then look at what's the likely equity premium, what's the likely illiquidity premium, and just getting to the returns that we want in this environment is tough. But I think that the sense of your question was more about my view of government, not my view of investment challenges. But,
yeah. But also where you see the economy going in light of the challenges in Washington and what the Fed is doing. I mean, again, there's a lot of disagreement about this out there.
There is, and it's an interesting week given David Stockman's editorial in the New York Times. A lot of people are talking about, are we on the edge of a cliff? I don't think we are on the edge of a cliff. I think we're in a delicate balance, and I have faith that we will make it through that balance. I don't think that the U.S. is going to fall off into the abyss, although we have printed a lot of money, we have taken on a lot of debt, and those trends are not likely to be able to continue. So one of the things we think about a fair amount in terms of risk control going forward is what if interest rates in the U.S. and worldwide were much higher than they are today? What does that do to our portfolio? What does that do to our investment theses? And do we want to have at least some trades in place that will benefit from that?
And are you anticipating that within the next couple of years? Do you think it's sort of inevitable, or?
It's really, I think the timing is very difficult. I don't think we can tell whether it's 6 months or 6 years, but it probably isn't another decade.
Yeah.
So I think there are some bright signs in the U.S. economy. It's one of these things in terms of where will the curves intersect. We have housing looking much better. We have, even though unemployment is still high, we have unemployment improving. We have businesses sounding very healthy and having good margins, good cash in the bank, and very low borrowing rates. So put all of those things together, and we might just be able to skirt by without coming to that abyss.
Great. Let's take some questions from the audience. I think there'll be people with microphones coming around. Anybody? We've got one in the middle here.
Can you share with us your asset allocation strategy and how much is tactical, how you implement it, how often do you reallocate and rebalance? Thank you.
Yes, so our strategy, we have a policy portfolio that we manage against, and on an annual basis we take a very close and hard look at that policy portfolio. That is our target and our measuring stick for our active management. So we have about a third of the portfolio in public equities, which is spread within the policy portfolio about equally between U.S., IFA, and emerging markets. We have about 10 to 12% in fixed income in the policy portfolio. The rest of the portfolio is in alternatives. And it's a broad mix, but a little heavier in private equity, and then 10 to 12% in real estate, natural resources, and about 15%, as you said, in hedge funds. What we do tactically during the year could vary from that quite a bit. And our success in tactical asset allocation is measured by whether the actual portfolio outperforms the policy portfolio. We also might outperform our policy portfolio by just doing very, very well in the markets that we're in and being weighted exactly like the policy in the actual portfolio. So there are two ways we try and beat the markets. One is within each market, and secondly, in tactical asset allocation. We rebalance. We look at our asset allocation relative to the policy on a weekly basis. We rebalance when we think we need to, and we're not terribly strict about going back to the weight. But when I work with a management committee of 5 who get together, we get together every week and talk about where we are positioned, how risky we think that is, and whether we think there are other opportunities that we want to go toward, and then we reallocate accordingly.
Hi, I was wondering if you could share your outlook regarding the venture capital asset class and how that may have evolved or changed over the last few years.
Sure. Venture capital. Venture capital has been kind of an interesting and tough road, I would say, over the last decade or so. But I think it's a very important part of our portfolio. Part of the reason it's a tough road is that the dispersion of returns in venture capital is probably the widest it is in any asset class. So for a large portfolio like ours, if we try to fill a bucket with venture capital firms and venture capital investments, we're probably going to end up being sorry. So we have to stay very disciplined with ourselves. Venture capital is enticing, it's exciting, it's interesting, and it's a source of growth. But unless we keep the allocation confined to the very best managers with the best access to entrepreneurs and track records for bringing those ideas to fruition, we're probably going to stand to not do well. So I like the asset class a lot. for a $30+ billion portfolio, it can't be a major part, but it is a really significant contributor to our returns, has been and will continue to be.
Great. I saw some more hands. There we go.
Hi, my name is Bill Daly. I had a Atlas Placement Advisors, a private funds placement group. My question extrapolates on the question about asset allocation and is somewhat multifaceted. But if you think about Harvard, which has been around for several hundred years and hopes to be around for another several hundred years at least, and other endowments of its quality, theoretically, your investment horizon should be commensurate with your expected longevity. So 25, 50, maybe even 100 years, but it's clearly impractical to invest for that time horizon. How do you balance the theory and philosophy of investing, given your projected longevity, with the human factor of the investment committee? And a cynic has once said that the investment committee's time horizon is the average tenure of the members of the committee. Also with the need for liquidity to fund your commitment to the university's operating expenses. So how do you balance all of the theory, philosophy, the human factor, and the need for liquidity, especially in light of 2008? We've seen many of your peers increase their allocations to more liquid investments in response to 2008, which in our view is directly contrary to your mission for investing for, again, theoretically the next 100 years or so.
That's a great question. We are, first and foremost, long-term investors, and we do think about things in terms of decades and probably multiple decades as opposed to quarters or years. On the other hand, one of the things that we've learned, and we learned through the financial crisis, is we don't have just one time horizon. So we could not lock up everything we have for 100 years and never think about it, especially if it wasn't cash generating. We do have to provide for the university, and the dollars that come out of the endowment to the university are very substantial on an annual basis. So we need to have a rotation of investments, some that we can reach in the relatively near term, some that are more intermediate, and definitely some that are longer, because being in that longer term category of investments means that we can take advantage of opportunities that other investors might not be able to. So a real challenge and an interesting intellectual exercise for us has been, what are those horizons? How much of this portfolio can be locked up long term? How much of it needs to be accessible within, say, a 5 to 10 year time frame, and how much in the shorter term? When we first invested in Timberland assets, we thought we would buy things and hold them for 20 years. And in fact, what happened in that asset class was the pricing changed so rapidly that it didn't make sense. We made 20 years of returns in 5. So we're always going to have to look at this in an iterative and flexible way. What we think was a long-term investment may turn out to be short-term for happy reasons like that. What we think was an intermediate-term investment may turn out to be long-term for not-so-happy reasons. And so we need to continue to reassess our portfolio and our opportunities going forward in light of what we have and what the university needs from us.
Okay, time for one more question.
Jane, over here, question. I'm John Furrier with Silicon Angle in Palo Alto, and my question to you is, you compared to Yale. Can you compare to Stanford and how they're handling their endowment, and specifically, what percentage of the endowment is royalty and patent-based?
I can't speak to how much of Stanford's endowment is royalty and patent-based. Royalties are an interesting area and something that we include in our hedge fund portfolio. It's something that I think can be very beneficial to a university. I think Stanford probably has in terms of its own patent office, a pretty substantial activity there, but I don't know that much about it. Sorry.
Okay, I'll just throw in one last quick question. Or can we take one more from the audience? Yeah. Okay, we can take one more. Go ahead.
Thanks. Maybe I'm one of the few that's coming from an emerging market. I'm coming from Turkey. What would your interest be around that region, specifically when a market is so growing and is a center of attention in political matters, in geography, in energy, in resources. That will be too specific, but I'll be happy if you answer. Thanks.
Yeah. We are interested in Turkey. We've had a number of investigations into Turkey recently, and it's one of the areas where, as you say, from a growth perspective, is very interesting. From a political and other risk perspective, we really need to balance that and also particular investment management opportunities. So I think it's an exciting market. We've definitely looked at it. We'll be looking at it in the future as well.
Great. So Harvard has outperformed its benchmark, I think, by roughly 300 basis points for decades. Will that continue to be possible, or has the world changed in a way where that's no longer a practical aspiration?
I think it will continue to be possible, but it's more challenging. And it's more challenging because, as I mentioned earlier, some of the areas that we entered as new investors 10, 20, even 30 years ago are now much more crowded. And so being able to be one of the first investors in private equity and venture capital, one of the first active investors in real estate, one of the first investors in natural resources in Timberland, we get there before the others, and there are some fantastic, juicy opportunities. Today we have many more colleagues as in other investors in each of these areas, and it gets tougher. On the other hand, we really set our sights to find those market inefficiencies and size our exposure to a geography or an asset class somewhat mindful of what those opportunities might be. So I think that we can do it. I think that it continues to evolve as to how we get there, and just the very most important piece is the mix of investment talent that we employ, both internally and externally, being of the very highest caliber.
Great. Thank you so much for sharing your thoughts with us, Jane Mendillo. Thank you.
Thank you.
Thanks, Jane.